Joining us now, Nigel Gault, Chief U.S. Economist at IHS Global Insight. Nigel, thanks for joining us. Let's talk about what price level first you expect oil to trade at, what range, and what price level would be dangerous for the U.S. economic recovery?
Well, we're expecting most likely outcome is that we see some easing back from where we are now over the next few months, because there probably will be some resolution in Libya. There'll be more supplies coming from elsewhere, and some of the present risk premium will come out. So that could take us back below $100 on the WTI price. That's the sort of outlook that we're building into our baseline. Now, clearly, there are plenty of risks out there. If you think about where we've come to now, we're probably up. We're up $10 to $15 since the start of the year. We reckon every $10 shaves about a couple of tenths off growth. So that, so far, is a mild break on the recovery.
Nigel, let me jump in for a second, because you mentioned what impact every $10 of increase of oil has on economic growth. Does it have to stay, though, at that increase for a month or 2 months or 3 months before it really has an impact here?
Sure, that's the sustained effect, because initially what happens, the price goes up, people tend to absorb a little bit. Their saving goes down a little as they absorb that hike. But if it remains and stays, then they gradually adjust their spending down. They gradually start to think, this is here for a while, I need to cut back elsewhere. That's when the impact starts to get bigger. It also gets bigger if you start to hit some big round numbers. We'd need to see a further spike in crude to take the national average gasoline price up to the $4 mark and beyond.
What could push us up? What could push us up there, Nigel? I mean, we hear a lot that Libya is 2% of the world's oil supplies, but there are concerns, I guess, if Algeria goes offline as well. I mean, what's happening, or what's possibly going to happen in the Middle East that could spike oil up again?
Well, you'd need to see continued standoff in Libya, continued turmoil there, damage to oil facilities, of course, would hurt. That would mean that supply isn't coming back quickly. And then beyond that, you'd need to see question marks over supply from Algeria, question marks over Saudi Arabia's ability to ramp up production to meet any shortfall. The more question marks over Saudi Arabia there are, then the more that cushion, which is presently restricting the price spike, the more that cushion comes into question.
So much of this has to do with how strong the economy is at this point. And you think the economy is looking pretty good, Nigel, before Libya erupted. I mean, how strong is it really? I mean, I feel like so much of it is artificial because of all of the stimulus that's out there and what the Fed is doing with QE2. I mean, so how strong is it really?
I think that the signals we were getting from all the surveys, ISM survey, manufacturing, ISM non-manufacturing, most of the evidence on the labour market, especially unemployment rate, say that we're picking up. I mean, I don't think growth this year is going to be much over 3%, so it's hardly spectacular growth by historical standards, but it's decent, it's above trend, it's enough to bring that unemployment rate down further by the end of the year.
Do you think it's going to be coming down further than people have forecast? I mean, is it going to be a positive surprise in this recovery?
It's been a huge positive surprise, obviously, over the last 2 to 3 months. Are we going to continue to get those positive surprises in the next several months? I don't think so. I think there could be some setbacks. The labour force is going to rise. We know people are going to return to the labour force. We may well see months out there where the unemployment rate pops up. Are we going to be lower at the end of the year than we are now? Yeah, almost certainly. Maybe we'll be down about 8.5 instead of 8.9. It's not going to be some one-way trip downwards like it's been over the past 2 to 3 months, though.
But what happens really, Nigel? Now, it's interesting. Joe Quinlan was saying that he thinks rates are going to stay low, I think, for another 3 or 4 quarters. So it sounds like we have
That's a while.
It is a while. So it sounds like we still have a lot of cushion. I mean, do we need to even start thinking about when the Fed starts to raise rates and steps off all of its easing programs and the impact that that's going to have on the economy? Or we've got lots of time, so don't worry yet?
Well, I think we've got lots of time. I would go along with the view that we're talking about sometime maybe March, April of 2012 before the Fed starts easing rates higher. And there's a lot of time to get ready for that. And as long as growth looks pretty good, as long as inflation, core inflation that is, doesn't spike up quickly, I don't think it will, people will be ready for the Fed move when it comes, and it's not going to come as a shock. There's plenty of time to get ready for that.
All right, hey, Nigel, thanks so much for joining us. Nigel Gault there from IHS Global Insight.